In this video, we will go through the most effective continuation and reversal patterns, and more importantly, we will show you the ultimate pattern that combines the main advantages of each group. This will be the most important chart patterns video you will ever watch online. We will show how you can apply these chart patterns to stocks, forex, and crypto trading. During this video, we also will show you how you can access our top-notch private indicator, known as QuantAlgo. This algo tells you when to buy and when to sell, giving you an insane advantage over other traders. Before we move on, if you want to show us your support and speed up the release of a lot of new content, make sure to hit the subscribe button and hit the notifications bell. So, chart patterns divide into three types: continuation patterns, reversal patterns, and bilateral patterns. Each group has its specific advantages and disadvantages. For instance, reversal patterns offer wider profit opportunities, but they require a wider stop loss and fakeouts are often present. On the other hand, continuation patterns require more conservative stop loss but offer much smaller profit opportunities. As for now, let's consider the most effective patterns from both groups. Let's start with one of the most effective reversal patterns, which is rising and falling wedges. Before we move to the specific market examples, let's consider how this pattern forms. The rising wedge consists of two converging trend lines that connect the most recent higher lows and higher highs. In a rising wedge, the lows are catching up with the highs at a higher pace, which means that the lower trend line is steeper. This indicates a slowing of momentum, and it usually indicates a reversal to the downside. So, our entry will be on the initial breakout candle. Stop loss should be placed above the recent swing high. When it comes to profit targets, we recommend you to target about 50% of the last upside wave. And here's a pro tip: volume should decrease or be lower than average as the wedge progresses towards the breakout, while during the breakout volume should be higher than average to confirm that this breakout is true. As for now, let's see the market example of the given pattern. Here's gold. And as you can see, we initially have a strong uptrend with almost all green candles in a row. The price then forms higher highs, enabling us to draw the upper trend line. At the same time, it makes higher lows along the bottom so that we can draw another trend line right here. We can also see that the lower trend line is steeper, showing us a loss of momentum. We also have lower than the usual volume during pattern formation, except this volume spikes, which is okay. So it gives us extra confirmation, and more importantly, we have a higher than average volume during the breakout candle, confirming that this breakout is true. So, we should enter the trade on this breakout candle, placing a stop loss above the recent swing high and initially targeting 50% of our last bullish wave. It is also important to note that entries can be different depending on your trading style. For instance, we may ignore the initial breakout and wait for a retest of the broken trend line. More aggressive traders may switch to the lower time frames for more aggressive early entries. So, if you are interested in learning these in-depth entry techniques, let us know in the comment section below and we will create a video about it as soon as possible. Now, let's see the bullish representation of the given pattern, which is a falling wedge. The falling wedge is a bullish reversal pattern. It arises when the price is making lower highs and lower lows which form two contracting trend lines. We will start looking for potential buying opportunities after the breakout of the upper trend line. Stop loss should be placed below the recent swing low. Like in the previous example, we recommend you to initially target about 50% of the last downside wave. As for now, let's move to the market example. So, the price initially was in a strong downtrend. Then the price begins to form wider swings, making lower highs and lower lows which form two contracting lines. So we can draw two trend lines. At this point, we should wait for a breakout of the upper trend line to enter the trade long. And here it is. We can enter during the initial breakout, placing a stop loss below the recent swing low and targeting about 50% of the initial downside wave. More secure traders can also enter on the follow-up pullback right here. So, moving to the next pattern, which is the cup and handle. The cup and handle is a bullish continuation pattern. As you can see, The pattern is formed after the price moves sharply in an upwards direction, after which the market begins to sell off and the price retraces slightly, helping to form the cup section of the pattern, which gives a rounded bottom appearance. The cup section of the pattern should equal from 30% to 60% of the initial move up to ensure a reliable pattern. As the price continues up, it retraces once again, this time more gradually, forming the handle section of the pattern. As always, we should look for long entries after the breakout of our major resistance. As for now, let's see the market example. Before we continue, we want to recommend to you our trusted and transparent broker, known as AAAFX. AAAFX offers the fastest trade execution with near zero spreads and institutional grade liquidity. You can trade various forex pairs, global indexes, the world's major blue chip stocks, major cryptos, and major commodities with solid leverage and fast execution. All you need to do is go to the Fund tab, set your preferred amount, and deposit funds with over 12 available payment methods. Furthermore, AAAFX services are integrated with ZuaTrade, which allows traders to copy trade from ZuaTrade master accounts directly to your account. Finally, this broker offers a multiplicity of trading platforms, including MT4, MT5, and ACT Trader. So, click the link in the description to check it out. Here's Aussie CAD. As you can see, we initially have a drastic move to the upside. Once the price approached resistance, it begins to pull back, forming a rounded bottom, which is the cap of our pattern. As you can remember, the cup section should not exceed 60% of the initial upside movement. In our case, it equals 40% so that we can move to the next step. The price then moves and pulls back once again to higher support, forming the handle. Ideally, the handle should equal around 30% of the height of the cup. At this point, we should wait for resistance breakout to enter the trade long. You can also look for high volume during the breakout candle to obtain an extra confirmation. Since it is a continuation pattern, we may jump into the trade immediately, because the probability of a pullback is too small. A stop loss can be placed below the low of the handle, while take profit should equal the height of the cup. With that being said, let's move to the next pattern, which is double top and double bottom. A double top is a bearish reversal pattern that is formed at the end of the uptrend. This pattern forms with two peaks above a support level, which is known as the neckline. The initial high is formed after a strong uptrend, and a follow-up pull back to the neckline. After hitting back to its neckline, the price rises again to form the second high. When the prices break through the neckline, our bias is confirmed so that we can enter the trade short. We should place a stop loss above the second high, while the initial take profit should be equal to the distance between the neckline and the second high. Let's see it in an example. Here's Ripple, and we have a moving uptrend right here. However, the price approaches the key resistance at this point and pulls back to the support, forming a neckline right here. As you can see, the price moves up once again, forming another swing high right here. So, our double top pattern has been completed. As for now, we should wait for the neckline break to enter the trade short. And here it is. So we can enter the trade right here, placing a stop loss above the second high and targeting the respective distance between the high and neckline. And as you see, the price dropped significantly. So, moving on to the double bottom. A double bottom pattern is a bullish reversal pattern that is formed at the end of the downtrend. Like in the double top case, this pattern forms with two lows below the resistance level, which is known as the neckline. The first low is formed after a strong downtrend, and then the price pulls back to the neckline. After hitting back to its neckline, the price falls again to form the second low. We confirm our bias when the price breaks above the neckline. We should place a stop loss below the second low, while the initial take profit should be equal to the distance between the neckline and the second low. At this point, let's see an example of the double bottom. Here's CAD. So, we have a drastic downtrend right here as the price trend down. The price then faces a significant support level and pulls back to the upside, forming the first low and the neckline. The price tests the neckline once again and falls to the support level, forming the second low. At this point, to activate our bullish bias, we should wait for the neckline breakout. And here's it is. As you can see, we can enter the trade right on this breakout candle, placing a stop loss below the second low and targeting the distance between the second low and the neckline. However, more secure traders can also enter the trade on this beautiful pullback right here. Moving on to the next patterns, which are ascending and descending triangles. Before we continue, we want to share with you our top private indicator, Quant Algo, which can be used in combination with previously discussed indicators or on its own. This high-quality algorithm, which combines complex trading processes to tell you when to buy and when to sell, was developed to enhance your trading experience. You can use it on any time frame for different asset classes. So, if you want to access Quant Algo to get results fast, all links will be in the description and the comment section below. Without this algo will put you at a disadvantage. The ascending triangle is one of the most effective continuation patterns that arise in the middle of the trend. So firstly, the market should be in an uptrend before the ascending triangle arises. The price then comes up and faces the resistance level, thus making the same highs along the top. At the same time, the price pulls back from this resistance and continuously creates higher lows along the bottom, allowing us to draw ascending trend line. These higher lows imply a bullish momentum gain. So we should enter the trade once the price breaks above resistance. We must place our stop loss below the recent swing low and target the distance which equals the height of the triangle. As for now, let's consider the market example. Here's Ethereum. As you can see, we have a moving uptrend right here. So that our first step is complete. The price then approaches some resistance on its way, thus creating the same highs along the top. Meanwhile, buyers are gaining momentum, as can be evidenced by higher lows along the bottom. Next, we must wait for the price to break above resistance. And here it is. We can enter right here, placing a stop loss below the recent swing low and initially targeting the distance which equals the height of the triangle. And as you can see, the price easily hits our take profit. With that being said, let's move to the bearish representation of this pattern, which is descending triangle. The descending triangle has the opposite criteria compared to its bullish version. Firstly, the price should be in a downtrend. The price then approaches the support level and makes the same lows along the bottom. At the same time, it creates lower highs along the top, which means that sellers are entering the market. So, we should enter the trade once the price breaks below support. Our risk management remains unchanged. We place the stop loss above the recent swing high, at the same time targeting the base of the triangle. As for now, let's see the market example. Here's Bitcoin. As can be seen, the price sharply moves lower right here. It then faces the support level and bounces back from it a few times, creating the same lows along the bottom. We can also see lower highs along the top, telling us about bullish momentum loss. Our trigger event for the trade entry short will be the breakout through this support. And here it is. Now, we can enter the trade right here with an stop loss above the recent swing high and take profit, which equals the base of the triangle. So, here's our top pattern, which we prefer to trade the most, which is bullish and bearish flag. The bull flag is a continuation pattern that takes place in the middle of an uptrend. As a result, it combines the main advantages of both pattern groups, thus enabling you to enter the trade with tighter stop loss and significantly wider take profit compared to other continuation patterns. A bullish flag consists of the flagpole and a flag. To form the pole, the price should make a strong move up on a relatively high volume. The price then consolidates within the two parallel trend lines in the opposite direction of the uptrend, forming the flag. It is also important to note that the pullback should not exceed 50% of the initial upside move. In this case, we must enter after the price breaks above the upper trend line, placing our stop loss below the lower trend line and targeting 50% of the flagpole. Let's take a look at the market example. Here's Apple. As you can see, we have an initial drastic move up backed by higher than average volume so that our flagpole is confirmed. The price then begins to consolidate, allowing us to draw two trend lines. Note that the price pulls back to about 38% fib level. So, our second step is done as well. Now, we should wait for the upper trend line breakout. And here it is. We enter the trade right on the breakout candle, placing a stop loss below the lower trend line and targeting 50% of the flagpole. And as you can see, our take profit was easily hit. So, moving on to the bearish flag. Bearish flag forms when the price shows an initial strong move to the downside and then a slight consolidation to the upside, allowing us to draw two trend lines. As you can remember, this pullback should be less than 50% of the initial move down. Our risk management rules remain the same. Our stop loss should be placed above the upper trend line, while the profit target should be equal to 50% of the flagpole. So here's the market example. Here's pound dollar. As you can see, the price trends lower, making lower highs and lower lows so that it forms the flagpole. The price then begins to pull back, allowing us to draw two trend lines. Also, this pullback is less than 50% of the initial downside wave. So the flag is formed as well. Now, we should wait for the lower trend line breakout. And here it is. We enter the trade right here, placing our stop loss above the upper trend line, and targeting the distance which equals 50% of the flagpole, and boom, take profit was reached. So, if you are enjoying the video and found it helpful, leave a like on it and comment, as this goes a long way and helps support our channel. Thanks for your time, and I'll see you in the next video.